Hello everyone. Coming to the final week, we're going to review the last three chapters, which are chapter 4, 19, and 28. Chapter 4, the value of common stocks. So these three chapters are mainly about how to value a company and how to value the stock. Number 3, dividend discount model. So company X is expected to pay an end-of-year dividend of $5 a share. After the dividend, its stock is expected to sell at $110. If the market capitalization rate is 8%, what is the current stock price? So we use the dividend of $5 a share, and this is the after dividend price, which is 110, and we divide it over 1 plus the market capitalization rate, which will give us the current stock price is $106. Number 4 is basically the same. Company Y does not plow back any earnings and is expected to produce a level dividend stream of $5 a share. If the current stock price is $40, what is the market capitalization rate? So there are two ways to calculate this question. One is to use the dividend stream, which is like a perpetual dividend in the future, $5 over the current stock price, $40, which will give us the market capitalization rate. Or we can assume that if it has a level dividend stream, which is perpetual of $5 a share, the current stock price is $40, so the stock price will remain the same because the earning hasn't improved or worsened. So using the formula above, we can calculate this using 5 plus 40 over 40, which will give us the 1.125. And we minus 1 from the 1.125, which will give us the same 12.5%. Valuing free cash flow. So Phoenix Corporation faltered in the recent recession but is recovering. Free cash flow has grown rapidly. Forecasts made in 2016 are as follows. From 2017 to 2021, net income, investment, free cash flow. So Phoenix recovery will be complete by 2021. So from 2022, there will be no further growth rate in free cash flow. So we want to calculate the present value of free cash flow, assuming a cost of equity of 9%. So first, we calculate from 2022 onwards, and we discount those free cash flow to 2022 using the annuity formula, which is 2.6 million free cash flow per year over the cost of equity, the discount rate, and it's $28.89 million. So we then discount those free cash flow to the first period, which is zero, standing at 2016, which is 0 over 1.09, 1 over 1.09 squared, 2, 2.3, 2.6, and from 2022, the worth at 2022 are total at 28.89 million. So the present value of all the free cash flow is $22.93 million. Assume that Phoenix has 12 million shares outstanding. What is the price per share? So with 12 million shares outstanding, Phoenix which sell for will sell for $1.9, which is the total value of the company over 12 million shares outstanding. So what is the Phoenix price to earnings ratio? How do you expect the price earnings ratio to change from 2017 to 2021? So the earnings are rising. If the price is the same, price to earnings ratio will drop, implying a lower and lower risk over the years. So with a net income of $1 million or 8 cents per share and a price per share of $1.9, Phoenix is selling at a PE ratio, price to earnings per share ratio, at 22.93. To show the return is equal to 9%. So we need to confirm that the expected rate of return on Phoenix stock is exactly 9%, which is the cost of equity from years 2017 to 2021. So if we use 9% to discount the free cash flow, we can expect that the cost of equity should be 9% because we already assume that. So standing at different starting points, we calculate the discount as follows. So at the end of 2017, Phoenix will be worth, so this is standing at the end of 2017. So this is the free cash flow of 2018, which is $1 million. This is 2019, and this is 2022 over the discount rate, which will give us $24 million. So if 2016 is 22 and 2017 is 24, the rate of return would be 9%. At the end of 2018, Phoenix will be worth, standing at 2018. This is 2018 itself, 19, 22, give us 27 million. And if we start from 2018, the value would be $24.99 million, sorry. The rate of return will still be 9%. At the end of 2019, this is interesting because we have to multiply 1.09 on the 2018 cash flow because now we are standing at 2019, and this is 20, 21, 22, give us $29 million. The rate of return is the same, And standing at the 2020, we have to forward the 2018 and 2019 to 2020, and now the worth is 32.37 millions, and the rate of return is still 9%. Well, the calculation is the same for the 2021, which is if we are standing at 2021, the rate of return is still the same. Coming to chapter 19, financing and valuation. 1, we need to calculate the WACC, weighted average cost of capital, for Federal Junkyards of America using the following information. So the debt has a $75 million book value, but the market value is only 90% of the book value. And the market value per share is $42. So if we get the market value of debt and equity, this is debt, which is 90% of the book value, and this is equity, $42 per share and 2.5 million shares outstanding. So the debt to the total value ratio is 39%, and the equity to total value share is 61%. And the WACC, this is the tax shield as always, give us 13%. WACC true or false? Use of the WACC formula assumes that A project supports a fixed amount of debt over a project's economic life. This is false because we don't need to fix the amount, we just need to fix the ratio. B, the ratio of the debt supported by a project to project value is constant over the project's economic life. This is true. C, the firm rebalances debt each period, keeping the debt to value ratio constant. This is true. APV and debt capacity. Suppose KCS Corp buys out a trucking company, a privately owned business, for $50 million. KCS has only $5 million cash in hand, so it arranges a $45 million bank loan. A normal debt-to-value ratio for a trucking company would be 50% at most, but the bank is satisfied with KCS's credit rating. Suppose you were valuing Patagonia, the trucking company, by APV in the same format as table 19.2. How much debt would you include? Explain briefly. So certainly, the trucking company on average would be 50% at most, so it's not able to support the 5 million cash in hand and 45 million bank loan, so it does not have a 9% debt capacity. Therefore, KCS is borrowing $55 million partly on the strength of its existing assets. Also, the decision to raise bank finance for the purchase does not mean that KCS has changed its target debt ratio. An APV valuation of Patagonia would probably assume a 50% debt ratio instead of the leverage 9. Table 19.3 shows a book balance sheet for a Wishing Well motel chain. The company's long-term debt is secured by its real estate assets, but it also uses short-term bank loans as a permanent source of financing. It pays 10% interest on the bank debt and 9% interest on the secured debt. Wishing Well has 10 million shares of stocks outstanding, trading at $90 per share. The expected return on Wishing Well's common stock is 18%. So we calculate Wishing Well's WACC. Assume that the book and market values of Wishing Well's debt are the same. The marginal tax rate is 35%. So from the balance sheet, we need to get the financing sources, which is from bank debt, long-term debt, and equity. And the bank debt is treated as permanent financing. So the capital structure is as follows. The bank debt, 280 million. The long-term debt is $1 billion, 1.8 billion. And the equity is $900 million worth. So the share, if we calculate, is the total, the bank debt over the total value, which is the sum of the three, give us 9.4%, and long-term debt to the total value ratio is 60%, and equity to total value ratio is 30%. So the weighted average cost of capital is, this is as usual the tax shield of the debt, and this is the required rate of return on bank debt. This is the bank debt ratio, required rate of return on long-term debt, 9%. This is the long-term debt ratio, and the equity, the rate of return multiplied by the share, and it will give us the WACC at 9.6%. Coming to the final chapter, chapter 28. Number 7, book rates of return. So Keller Cosmetics maintains an operating profit margin of 9% and a sales to asset ratio of 3. It has assets of 500,000 and equity of $300,000. Interest payments are 30,000 and the tax rate is 35. So what is the return on assets? First, we need to get the return, and we have the assets of $500,000. So this firm has a sales to assets ratio of 3, and it has assets of 500,000. So the sales is $1.5 million, and the after-tax interest plus the net income, which is the sales, and the operating profit margin is 8%. So the total profit would be $120,000. So the return on assets would be the total profits over the assets, which is 24%. And what is the return on equity? So if we need to calculate the return on equity, we need to show the net income, which is the profit minus the interest payment, which is 100,500. So this is the net income that is available to the equity holders. So the return on equity is $100,500 over the value of the equity, which is $300,000, and it gave us the return on equity of 34%. Debt ratio. A firm has a long-term debt-to-equity ratio of 0.4. Shareholders' equity is $1 million. Current assets are $200,000. And the total assets are $1.5 million. If the current ratio is 2.0, what is the ratio of debt to total long-term capital? So the long-term debt to equity ratio is 4%. And shareholders' equity is 1 million. The equity is 1 million. So 1 million over the long-term debt to, 1 million times the long-term debt to equity ratio of 0.4 will give us the long-term debt, the value of the long-term debt. So the value of long-term debt is 1 million times 0.4, which is $400,000. So the long-term capital equals long-term debt and the total equity. The long-term capital would be 1.4 million. And if the current ratio is 2%, and the total assets are 1.5 million, and the long-term capital is 1.4 million. So the total liabilities would be total assets minus all the equity. So total liabilities would be 500,000. And the ratio of debt to total long-term capital is, this is the total liability, total debt over the long-term capital, which is the long-term debt plus the equity. And we had it in the previous page. It's 1.4 million. So the ratio is 35%. And that's all for the review of this quarter. And I really enjoy the privilege of working with you. And I wish you all good luck in the final week. Thank you. Goodbye.